Hey there, and welcome to the Deep Dive.
Glad to be here.
Today, we're really zeroing in on the latest earnings call transcript from Seanergy Maritime Holdings Corp.
Yep, they just walked through their first quarter 2025 results and gave some company updates.
Exactly. And our mission, as always, is to cut through all the jargon, pull out the really important bits of knowledge and insight from this call.
Give you a shortcut, basically, to understanding what they talked about and, maybe more importantly, why it matters.
Right. So the context here is Seanergy coming into 2025 after a really strong 2024.
Yeah, feeling pretty good about the long-term prospects for the Capesize market, the big ships.
Even though, as we'll see, Q1 itself was, well, a bit softer on the earnings front. Let's dive in.
Sounds good. And yeah, while the Q1 numbers maybe show some, let's say, temporary issues, the big theme from the call was definitely management's confidence.
Confidence in the underlying market.
Right, and fundamentals of the sector, and also confidence in their own strategy, how they're navigating things now and setting up for the future. Okay, let's kick off with a quick snapshot then. What were the headline numbers for Q1 2025?
Okay, so for the first quarter, Seanergy brought in revenue of $24.2 million.
Okay.
Their average daily earnings per ship, they call it TCE, time charter equivalent, that landed at $13,400 per day.
$13,400.
Got it. Which led to an EBITDA of $6.6 million.
Okay.
And they did report a net loss for the quarter of $6.8 million.
A net loss. And cash position.
They finished the quarter with $31 million in cash on hand.
Okay. Now, how does that stack up against Q1 last year? Because, like you said, 2024 was pretty strong for them.
Yeah, it was definitely a step down. Really shows that softer market they were dealing with.
How much of a step down are we talking?
Well, their TCE in the first quarter of 2024 was way higher. $24,100 per day.
Wow. Okay. Big difference.
Big difference.
Yeah.
So yeah, Q1 this year was clearly a period of, lower earnings across the board.
But I think I saw something about them still performing okay relative to the market, even in that weaker environment.
They did, yeah. They made a point of saying that their $13,400 TCE actually beat the average rate for the Baltic Capesize Index.
Oh, interesting.
By about 3% during the quarter. They kind of held that up as a positive reflection on their commercial team's work.
Okay. So, market soft, numbers down year on year, but still managing to outperform the average. Let's dig a bit deeper then. What did management really emphasize when they talked about the financials, the operations, how they're spending their money?
Yeah, I'd say the main theme here was really balance sheet strength and strategic flexibility.
Okay.
They mentioned adjusted EBITDA came in at $8 million. And an adjusted net loss of $5.2 million numbers they felt better showed the underlying operational performance.
Right, stripping out some items.
Exactly. But they really, really hammered home the strength of their balance sheet.
Okay.
You mentioned the $31 million in cash. Add to that total assets around $603.5 million, equity at $254.8 million, and total debt sitting at $323.7 million.
And what does that mean in terms of leverage?
Crucially, it puts their loan-to-value ratio below 50%.
Ah.
And if you're following shipping, that's pretty healthy. It gives them a lot of breathing room, especially when you hit these market dips like Q1. They also noted they manage cash flow pretty well, even with making acquisitions.
Right. And speaking of acquisitions, they actually bought ships this quarter, didn't they? Which seems kind of bold in a softer market.
It is, yeah. They picked up 2 more high-quality Japanese-built Capesize vessels.
Okay, tell me about them.
So one was the Blue Ship, built in 2011. They initially took that one on a 6-month bareboat charter, basically renting a hull first.
Okay.
And put it straight to work on an index-linked contract, but that also had a fixed premium on top, so some upside potential.
Gotcha. And the second one?
The other was the Mesh Ship, so a bit bigger, a 2013 Newcastle Max. They bought that one using some cash and some new bank debt.
And how's that one employed?
Also on an index-linked hire contract, but the key thing here is it has a guaranteed profitable floor rate.
Ah, downside protection.
Exactly. Some protection there. And they stressed both deals were done on pretty favorable terms and started adding to cash flow right away.
Okay, adding ships means you need the money. And keeping the balance sheet strong takes smart financing. What do they manage on that front?
They were busy, yeah. Closed out 2 significant financing deals, totaling $88.1 million.
Okay. What were they?
First up was a $53.6 million sustainability-linked loan with Pyre Bank.
It's sustainability linked. Interesting.
Yeah, it helped refinance some older debt and partly paid for that Menship purchase. And they got better terms, too. It's a 5-year deal priced at 2.05% plus term SOFR.
Which is the new benchmark replacing LIBOR.
That's the one.
Yeah.
And that rate is 55 basis points lower than the debt it replaced. Plus, there's potential for it to go even lower if they hit certain emissions targets.
Lower costs are always good. What was the second deal?
They also did 2 sale and leaseback agreements, totaling $34.5 million with affiliates of Hung Financial Leasing.
Okay, sale and leaseback. So they sell ships and lease them back.
Pretty much. It refinanced debt on 2 other ships they own. The deal involves a 5-year bareboat charter where Seanergy keeps operating the ships, and they have options and an obligation to buy them back at the end.
And the financing terms there?
The rate is 3-month term SOFR plus 2.15%. They pointed out that's a solid 130 basis points lower than the average rate on the debt they paid off with it.
So it seems like a clear strategy to lock in better interest rates and push out any debt deadlines.
Exactly. That was a key point they made. With these deals done, they now have 0 debt maturities coming up for the next 4 quarters.
Okay, that's a significant runway.
Huge runway. Gives them a lot of financial flexibility. They're not staring down any big debt payments soon, so they can focus on shareholder returns or jump on good market opportunities if they pop up.
Makes sense.
Oh, and they also mentioned they're in advanced talks to get the funding sorted for that purchase option on the blue ship, the one they chartered first. That's due later this summer.
Okay, good to have that lined up. Let's shift gears slightly. What about just running the ships day to day? Operational costs.
They highlighted some improvements there too. Daily operating expenses, OPEX, were actually down by 7% compared to last year.
Oh, nice. How'd they manage that?
They mainly put it down to using their own in-house technical management team for dry dockings now, especially on the newer ships. Seems like that's proving more cost-effective for them.
And speaking of dry dockings, what's the plan for the rest of 25? Because that takes ships offline and costs money.
Yeah, it does. They have about 7 ships still scheduled for dry docking this year.
7, okay.
They did say they might strategically push 1 or maybe 2 of those into the first quarter of 2026, depending on how the market looks later in the year.
Flexible approach.
Yeah.
What's the estimated cost?
They're budgeting around $10 to $14 million in capital spending for those dry docks in Q2 through Q4. And they figure each ship will be out of action for about 20 days on average.
Okay. And how many done so far this year?
4 have already been completed earlier in the year.
All right, let's talk capital allocation. How are they thinking about giving money back to shareholders, especially after a softer Q1? Did they cut the dividend?
No, actually. They declared a 0.05 cents per share dividend for Q1.
Okay, 0 to 5 cents.
And what was really notable is they specifically stated this payout was higher than what their own dividend formula would have spit out based just on the Q1 results.
Oh, really? So they paid more than the formula required?
Exactly. They framed it as a deliberate signal, a sign of their confidence in the long-term market, the fundamentals, and their commitment to stable returns, even when the market takes a temporary dip.
That's a strong message.
It is. And they reiterated their overall capital allocation strategy includes these consistent dividends, plus opportunistic share buybacks when it makes sense.
So, stepping back, what are the main priorities for capital for the rest of 2025 then?
It sounds pretty much like they're sticking to the plan they had in 2024. Priority 1 is capital returns, dividends, and buybacks. Priority 2 is disciplined, opportunistic fleet growth. But, and this is important, they explicitly said finding genuinely compelling ships to buy right now is difficult. They're scarce.
So no immediate shopping spree planned?
Doesn't sound like it. They don't have anything lined up because the right opportunities just aren't there on terms they like. And priority 3 is just maintaining that balance sheet strength we talked about.
Got it. Returns, selective growth if possible, keep the finances strong. Okay, let's pivot now to the crystal ball section, the market outlook. You said Q1 was seen as a temporary thing.
Yeah, they described the Q1 softness as a temporary correction, partially seasonal, which isn't unusual for Q1.
All right, often a weaker quarter.
Yeah, but it was kind of made worse this year by a couple of specific things. They mentioned severe weather hitting Australian iron ore exports for a while.
Okay, disruptions.
And also, high coal inventories that were built up during 2024 meant there was less immediate need for coal shipments early this year.
But things picked up.
Sharply. They pointed to the rebound in spot rates that happened within March. Rates apparently jumped dramatically from lows around $6,000 a day up to highs touching roughly $23,000 a day.
Wow, okay, that is quite a swing back. So does that recovery mean the longer-term view for Capesizes is still positive in their eyes?
According to management, absolutely. They believe the long-term fundamentals are still very robust.
What's driving that confidence?
It really boils down to two main forces as they see it. One, extremely limited growth in the supply of new vessels. And two, steady, resilient demand for the key stuff Capes carry, like iron ore and coal.
Okay, let's break down that supply side first. What makes them so sure it's constrained?
Well, the supply picture is, and I think this was their term, extremely favorable.
Favorable for ship owners, you mean?
Exactly, for owners. Look at the global order book for new Capesize and new Newcastlemax ships. It's currently just under 8% of the existing fleet on the water.
Is that low?
Historically, that is incredibly low. Think about it. That's minimal new supply coming, even before you think about replacing old ships.
And are there many old ships?
Yeah, about 10% of the current fleet is over 20 years old. These ships are becoming less competitive, especially with new environmental rules kicking in.
Right, the efficiency regulations.
Exactly. And getting new ships ordered is tough. Shipyards are apparently full, building container ships and LNG carriers mostly. New ship prices are high. And there's still a lot of uncertainty about what kind of fuel or propulsion technology to bet on for the future.
So owners are hesitant to order.
Seems like it. They noted only just six, new Capesize orders have been placed globally so far this year.
Wow.
So net fleet growth, they expect it to be only around 1.5% in 2025, maybe 1.9% in 2026.
Which is tiny.
Tiny. And then you factor in ships spending more time in dry dock and these environmental rules like EXI and CII forcing ships to sail slower to cut emissions.
Which reduces how much cargo the fleet can actually move in a year.
Precisely. It reduces the effective supply. So the actual growth in carrying capacity could be even lower than those numbers suggest, maybe even negative at times. The bottom line is very little growth in ship supply for the next few years.
Okay, that's a powerful argument on the supply side. What about demand? Is that holding up its end of the bargain?
They see demand for the major dry commodities as steady and resilient. Global steel demand seems relatively strong.
And China, iron ore.
China's iron ore imports are actually growing. Even with flat steel output there, they're importing more because their own domestic mines are producing less, and they're shifting towards higher quality imported ore.
Okay. What about the big exporters? Australia, Brazil?
Australian exports were down year to date because of that weather we mentioned. But importantly, the big mining companies there have all stuck to their full-year export guidance.
Meaning they expect to ship a lot more in the coming months.
Suggests significant upside.
Yeah.
Catch-up volumes. And Brazilian iron ore exports, they're actually up year to date, even compared to a strong start last year. And their peak export season runs from about now through November.
Right.
Plus, Brazil's also producing more of that higher grade ore.
Yeah.
And remember, Brazilian cargoes have a much bigger impact on shipping demand.
Because of the distance, right?
Yeah, the distance to Asia, mainly China.
Yeah.
So much longer than from Australia. Each ton from Brazil basically needs about triple the shipping capacity measured in ton miles compared to a ton from Australia.
Right. So more Brazil volume really tightens the market.
Magnifies the effect, yeah.
And wasn't there a specific new project they highlighted as a potential demand driver?
Yes, a very significant one. The CMONDO iron ore project in Guinea, West Africa.
Ah, CMONDO. Heard a lot about that.
They stated it's still on track to start exporting in November 2025. They called it a game changer.
Strong words.
Yeah. A long-haul premium grade Capesize exclusive trade. Basically, huge volumes traveling very long distances, specifically suited for Capesize ships. And they made it clear they plan to be part of that trade.
And what kind of impact could that have overall?
This project alone is expected to boost overall iron ore ton-mile demand significantly, maybe adding around 5% annually in both 2026 and 2027, just from CMONDO ramping up.
Okay, that's a serious catalyst. Are other commodities helping out besides iron ore?
Absolutely. Bauxite, used for aluminum, exports from Guinea have just exploded, up 43% so far this year.
43%, wow.
Yeah, they're projecting Guinea could export 200 million tons this year, compared to about 145 million last year, driven by aluminum demand. Bauxite is now a massive cargo source for Capes.
Okay. Any others? Coal.
Thermal coal imports were down a bit year to date, like we discussed, mainly due to those high inventories and also lots of hydropower generation in China recently. But they expect coal demand to rebound in the second half of the year as those stockpiles get worked down. So yeah, overall demand looks pretty robust or improving across the key commodities.
Okay, so let me try to summarize the outlook picture. You've got minimal, maybe even negative effective ship supply growth.
Right.
Running headfirst into pretty solid and potentially growing demand, which is being boosted by specific big projects like CMONDO.
That's the narrative, yeah.
So what's the management's ultimate conclusion for the market direction?
Their summary is pretty clear. With extremely low fleet growth and these structural inefficiencies like slow speeds and dry docking taking capacity out, they project progressively tightening Capesize utilization in the coming quarters.
Meaning?
Basically, more cargo chasing relatively fewer ships, which usually means higher freight rates.
Okay. Given that positive outlook, did they give specific guidance for the second quarter, Q2 2025?
They did. They guided for an expected TCE of approximately $19,100 per day for Q2.
Okay, $19,100. That's a nice jump from the Q1 number of $13,400.
Significant jump. And importantly, they said that level is expected to support a return to their more, let's say, normalized levels of dividends and other capital distributions.
Right, back towards the formula perhaps. And didn't they also mention they've already locked in some rates for ships, hedging?
They did, yeah. And this gives them pretty good forward visibility, reduces risk. For Q2, they said about 39% of their operating days were already covered by hedges at an average rate of roughly $22,700 per day.
Wait, $22,700. That's higher than their Q2 guidance of $19,100.
It is. The guidance reflects the current market expectations based on forward curves, while the hedges were likely locked in earlier or represent specific profitable contracts.
Okay, interesting. What about further out?
Looking through the rest of the year, into 2025, they've secured long-term coverage for about 1/3 of their available fleet days at an average daily rate above $22,000.
So a solid chunk of revenue locked in at profitable levels.
Exactly. Provides a good baseline of profitable cash flow, sort of regardless of where the spot market goes day to day.
Okay, let's try and put this all together for you, the listener. Why does digging into Seanergy's Q1 call actually matter if you're following the shipping sector?
Well, I think it paints a picture, right? You see a company that hit a temporary earnings dip in Q1.
But didn't panic.
Didn't panic. Armed with a strong balance sheet, they have a clear strategy to navigate it. And they're loudly highlighting what they see as really compelling long-term reasons to be positive about the Capesize market.
Especially that supply constraint story and the demand catalysts like CMONDO.
Right. The call kind of signals how a well-positioned company, one with financial strength, can actually make opportunistic moves, like buying those ships on good terms during a weaker patch.
And use tools like hedging to lock in future revenues at pretty attractive rates. Rates that, as we just noted, are actually higher than their current Q2 guidance based on the market curve.
Yeah, it gives you some insight into the potential playbook for successful players in this space right now. Use your financial strength to ride out the bumps, be ready to grab rare good deals on assets, and try to lock in future earnings when you can.
Okay, makes sense. Which brings us to our favorite segment. This is not financial advice.
Always preface this one heavily.
Absolutely. Everything we talk about here is purely for your information, maybe a bit of entertainment. It's just a thought exercise based only on the information presented in the earnings call we've been discussing. No recommendations here.
Just connecting some dots they laid out.
Exactly. So given everything management discussed, that strong conviction about supply constraints for years, CMONDO being called a game changer starting this November,
Right.
the projection for tightening utilization, the fact they're a pure play Capesize owner, and they've already locked in hedges well above their Q2 guidance.
A lot of bullish signals from management.
Right. So here's an outrageous but plausible trade idea, framed completely hypothetically, like something you might overhear analysts kicking around.
Okay, let's hear the hypothetical.
You might hear someone argue, look, management's basically saying effective ship supply is going nowhere, maybe even shrinking, for years. Meanwhile, demand has these huge specific boosts like CMONDO about to hit, fundamentally changing the shipping equation. They're already locking in future work at over 22 Ks a day, way above where the market curve implies rates should be in Q2. Maybe, this hypothetical person argues, maybe the market is just too focused on the Q1 dip and hasn't woken up to the structural squeeze coming in the second half of 25 into 26. Maybe this whole CMONDO thing plus zero supply growth creates a massive imbalance that isn't priced in yet.
Okay, so the wild idea stemming from that.
The wild but plausible thought could be, perhaps take a speculative, maybe even leveraged long position on a pure play name like Seanergy. The bet would be that rates don't just recover to that 22K plus level they've edged at, but potentially blow past it and stay high as the supply-demand gap really bites later this year and next, forcing a major re-rating of the stock.
Right. Betting that management's very strong conviction about the supply-demand imbalance proves correct, and the market hasn't fully grasped the implications yet, especially with CMONDO on the horizon.
And let us be absolutely crystal clear again. That is highly speculative. It is absolutely not financial advice from us. It's just one example of the kind of thinking that could emerge strictly from the points management emphasized on this specific earnings call. For your consideration only.
Please always do your own research. Understand the risks. Shipping is volatile. This is not a recommendation.
Okay. So to quickly wrap up this deep dive into Seanergy Maritime Holdings Corp's Q1 2025 earnings call, the core message seems to be navigating a temporary soft patch, but with strong conviction in very positive long-term fundamentals for Capesize shipping.
Yeah, backed up by their balance sheet strength, those disciplined growth moves they made, and the forward revenues they've already secured through hedging.
And just one last time, this deep dive was purely for informational and entertainment purposes. It is definitely not a recommendation to buy or sell SMHI or any other security.
Definitely not.
But we will leave you with a final provocative thought to mull over. Management talk really strongly about extremely low fleet growth, lasting for several years. They talked about big demand drivers like CMONDO coming online soon, and they mentioned how hard it is to find compelling candidates to buy good ships, just aren't easily available on attractive terms.
Right, scarcity value.
Exactly. So what does that combination truly suggest about the underlying, maybe intrinsic value of the existing well-managed Capesize ships already out there in this kind of supply-constrained world? And how should you think about the potential gap between that value and how the stock market is pricing these assets today?
It certainly raises a fundamental question about valuing scarce productive assets in what they clearly believe is a tightening market environment. Something to think about.
Indeed. Thank you for joining us for this deep dive.